Hello and welcome to episode 433 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
Well, I'm actually a little bit down, if I'm honest, Andy, because, the news broke just before we came on air that one of the budgeting apps, Money Dashboard, is closing. Now, I'm not one for telling people all the apps and bits and pieces I use, and because I think it's sometimes because of a bit of unfair bias on certain things, but Money Dashboard was an app that I absolutely loved and did use regularly, and it was the main budgeting app I used. So those of you who don't know, Money Dashboard was one of the free budgeting apps. There are other apps out there like Emma, for example, which are popular, but they are fairly expensive in terms of cost. Because Money Dashboard did a lot of the stuff that other apps charge for. They did it for free. Now, it's closing down at the end of October. And the reason I mentioned it at the start of the show is because the news has only just broke and there'll be plenty of people out there who don't use the app. But those who did use the app were real advocates and fans. And I've had 2 or 3 emails already from people saying, what can we do? Which apps can we use as an alternative? And as somebody who has used the app for a long time, I'm kind of in the same boat. So what we're going to do is keep an eye out on the content on the Money to Masses website and YouTube channel, but particularly for podcast listeners, next week we are going to do a piece on the podcast about budgeting apps and in particular the alternatives for people using Money.
Yeah, it's a surprising bit of news actually, because Money Dashboard is one of the top, or was one of the top budgeting apps in the UK, but there are banks that do similar things. But the reason we liked Money Dashboard and Emma and others like that is they're independent ones that pull all of the information through from all of the different banks. Some of the limitations you get with the banking apps that do this categorizing of your budgets is they will do very limited things with external banks and bits and pieces like that. And so, as you say, we'll round it up on next week's pod.
And some people might just be thinking, why have they closed it? And it's actually down to the fact they couldn't make the numbers work in terms of the business model. So they weren't charging for the app. Inevitably, if they can't make it work, they're going to have to close it down. So moving swiftly on before we all become depressed about budgeting apps in this world, and there'll be plenty of people who don't really actually care. But what's on this week's show? So on a positive note, what we're going to talk about this week, I'm going to do a bit of almost economics and talking about bonds. So something to do with the yield curve. Don't worry if it's something that you're not really into. It might sound a little bit heavy, but for those of you who aren't into investing, what I'm going to talk about, which is called bear steepening, it is important in terms of the implications for the US economy in particular, but also therefore the global economy. The next piece we're going to be doing is Harvey's going to be on the show. We're going to be talking about protection more broadly, but particularly life insurance and pre-existing medical conditions. So we write a lot on the Money to the Masses website and we talk about different types of pre-existing conditions. The concern is there's a lot of people out there who may have pre-existing conditions and sit there and put off getting life insurance. We want to do a quick roundup of all of the major, probably most common pre-existing conditions out there, tell people the impact it could have on not only getting life insurance, but the cost. Now, the good news, I'm going to give you a little bit of a sneak preview, is that we're trying to show people that actually life insurance is affordable for everybody. And we don't want people putting off getting life insurance because they're thinking about maybe waiting until they've lost a bit of weight or something like that. All will be revealed when Harvey's on the show later. And Andy, the final piece in the podcast is something that I'm particularly interested in. You're going to be covering...
Well, there was some news this week about minimum wage, and so we're bringing that together with young people working as well, because we've been discussing in the office, we've got young daughters and sons who are getting that age now where they want to be a little bit more independent, they want to start earning some money. And so we took a quick look at what the actual rules were in terms of how long they can work legally, how many hours they can do, and what they can actually earn in terms of pounds and pence. Does the national minimum wage actually apply to them, for example? We'll cover all that later in the show.
Yeah, and we're particularly talking about children who are under the age of 16. So if you've got teenagers like we have who want to earn some money babysitting or whatever it is, then this will be of interest.
Okay, so let's start off with our investing piece, and the bear steepener is what you said earlier. I've never heard those two words put together. No idea what's coming up, but I'm sure it'll be interesting.
So what I want to talk about is a phenomenon that occurred in the last couple of weeks in the US. But before I get into too much detail, I just need to give you a bit of a backdrop about bond markets. And in particular, if you go back and listen to episode 197 of this podcast, we'll put a link in the notes of this show. show, there's a whole episode that I listened back to before I came on air, and I did a very good explanation, which does sound a little bit self-congratulatory, but a very good episode on the yield curve and bond market. So a bond is essentially a loan to one of these entities. And so if you think about it, you're loaning the money to that company or that government, and then you get interest payments called coupons that happen throughout the period of the loan. And at the end of the loan, you then get the principal amount back. And so those loans can be over different time frames. And so that's obviously got a maturity date. Now, when you get all of those, if we think about it in terms of, let's just go with the US, we're talking about US treasuries. If you think about the different terms of these loans, so the treasury loan could be for, say, 1 year, 2 year, 3 year, 5 year, 10, 30 years, and you took the yield from each of those treasuries and you plotted them on a graph. So along the x-axis, you've got the maturity date or the time until maturity, and on the y-axis, you've got the yield that you're getting. So it's essentially a function of those repayments that you're going to, interest payments and the final capital. Then that would give you a yield. If you plotted that, what you would theoretically get in most instances in a normal environment is that you would get a line, if you joined up all the dots, that would go from the bottom left and it would slowly curve up to the top right, because you would want a higher interest rate for lending money to an entity for a longer period of time. That's the general shape, and that's called a yield curve. And I'm not going to go into details on the podcast this time around, because you can listen to that episode and I give a very good explanation about how it works. But the point is that the yield will be lower at the shorter end, and as you get to the longer maturity dates, the yield you'll get will be higher. So let me now just mention about yield curve inversion. So again, I mentioned it on that podcast, give an explanation, so go and listen to that. But in very simple terms, what happens with a yield curve inverts, the yield that you get on a shorter dated treasury can end up being higher than the yield you get on the longer dated US treasuries. And of course, you might think, well, why would that be? Now, to give you a scenario where that would possibly happen is if the investment markets, economists, they thought there was likely to be a recession. So if you take an environment, let's say that interest rates are rising like we're in now, and so central banks are putting up interest rates. They might be worried about the economy overheating or what's happening now, inflation. So they put rates up. That means that the yield that you would get or you would expect to receive on a loan to the US government over a shorter term, you'd expect more, wouldn't you? Because why wouldn't you just put your money in a savings account, for example? So the yield on the shorter end goes up. But what people are thinking is, well, if we put up rates too high, too quickly, it could actually start to have the desired impact of slowing down the economy and consumer spending, etc. But if it's too tight, if it's too aggressive, then it can actually send the economy into a recession. And of course, in a recessionary environment, then what happens? Central banks tend to cut interest rates. And of course, that would therefore drive down the expected yield in the future. So what you get is a yield curve that inverts, because the longer term expectation of where rates might be will be lower, because people are thinking there could be a recession in the future. But right now, obviously, rates are very high because of what central banks are doing and what's going on in the economy. So that's why when you get that shape, that inversion, people think it's an omen or a harbinger of a recession. And often in the past, it has been true. So that was something we talked about in the past. And actually, when I did that podcast, that was, I think, in 2018. And we talked about there wasn't at that point an inversion, but they were worried it would happen. Well, it did. And of course, we did have technically a recessionary period, but that was because of the pandemic. But we've had the yield curve invert again since then. So we had that last year, globally almost. So we had it in the US, we had it here in the UK. We've not quite had the recession yet, but we're sort of teetering on the edge. So that's the first thing. The bond market is bigger than the equity market. And so it's often said that when the bond markets tell you something, it's definitely worth listening. And so the bond market has been telling the world that, yeah, we're going to have a recession maybe in the US, the UK, but stock markets haven't really reflected that. Now, with that all out of the way, what's this bear steepener that I'm talking about? Well, a bear steepener is a scenario where you get the yield curve. So we've gone from the inverted version. So it's going from almost, if you think of that graph I talked about earlier, going a little bit more from the top left to the bottom right in terms of curving. What you start to get is you start to see the yield on the longer dated US treasuries rise more quickly than those at the shorter end. Or you could even get the ones at the shorter end don't move up at all, or they could even fall slightly, which is what we've seen seen recently in the US, while the yields on the longer dated US Treasuries go up. And the increase is more significant at the longer dated end. And of course, that then is unusual because you can get the curve steepening. Let's just say all the yields started to fall right across from, say, the short end. You might be talking about 1 year, 2 year. Let's say they fell more than the yields at the other longer end, then you can get it sort of steepening. If you think of it as a seesaw, so we start to go from a curve going down from top left to bottom right, more going from the bottom left to the top right. So that's steepening. But what we're getting now, which is what makes it interesting, is that the short-term yields are falling ever so slightly, but largely unchanged, but we're getting a big movement on the far end. Now, think about why that could happen. That can happen because the market is starting to readjust its interest rate expectations. So what it's doing is sitting there thinking, actually, I think interest rates are going to be higher for longer, and central banks are going to struggle with inflation, which links very nicely to what I was talking about on last week's show. They've suddenly just realised that actually inflation might be hanging around for longer. Maybe they listened to last week's podcast, and therefore they start to price that in. And if the market starts to think that central banks, the Bank of England in the case of the UK, the US Federal Reserve in the case of the US, that those central banks will have to keep rates higher for longer to really tame inflation, that's why the short term, they are thinking that interest rates have hit their peak or nearing it at the short end, but they're sitting there thinking, actually, they're not going to drop away as quickly. They're going to stay higher for longer, so they've readjusted. So why did I mention the inversion with the bear steepener? Well, because when you get a bear steepener after a yield inversion has occurred, you've got to think the first one was obviously a sign that you might be getting a potential recession. So in the US, we didn't get that. So it isn't obviously foolproof. But now, whenever we've had since the 1970s, there's been 5 occasions actually since the mid-1970s where there has been a bear steepener after an inversion, then that has had a 100% record of predicting a recession. So what this really is, if you think about it, is the bond market, which is the biggest and most powerful market, is essentially saying, we thought there's going to be a recession. Now we really think there's going to be a recession in the US. And of course, that old phrase, if the US sneezes, the rest of the world catches a cold. So that's why even if you don't care about investment markets, you don't care about bond markets in particular, it's just a sign that actually there's been a shift, and it's happened in the last week in particular, but there's been movements already that's been happening in the last, I'd say, couple of weeks, where we're seeing bond yields rise very rapidly, but this bear steepener in the US to suggest that they are worried about maybe there being a recession in the US. So I wanted to teach people a little bit about the dynamics of bond markets, a little bit how that is relevant to everybody, even in the UK. But the reason I forgot to add is, why is it called a bear steepener? Well, it's because it's normally bad news for equity markets. So that's where the bear part comes from. So this isn't a good news piece. The last 2 bear steepeners that we had following an inversion on the US yield curve were in 2020 and 2007. So one was just before the pandemic and one was just before the financial crisis. I think the pandemic, I'm not sure you can claim that bond markets can predict an outbreak of COVID, but nonetheless, its record still holds. So that may be a sign that we were already heading into a potential recession at that point. And I remember going back to that point, there was talk about maybe a recession coming along. So there you go. The bear steepener, you now know a little bit more about bond markets. That's why bond markets are interesting, even if you don't invest in them and if you just invest in equities. Right, so Harvey's come onto the show today to talk about pre-existing medical conditions with protection insurance. So we're particularly going to focus on life insurance because it keeps it simple. But the aim of the piece is that we're going to talk about common pre-existing conditions to encourage people to go and seek advice, and also to illustrate that not only can people with these conditions get life insurance, but they can also get it at an affordable rate. So the first thing Harvey's going to do is give us the sort of common thread to start with.
Yeah, so we're going to talk about a few conditions today. We're going to include things like high blood pressure, raised cholesterol, diabetes, epilepsy, and a few other conditions. But what we want to say is that regardless of what medical condition you may have, there are some things that are common to everything. So if you've been diagnosed quite recently, then it may be difficult to get cover, but what you should do is get in touch with an insurance broker and get an application in so that a life insurance company can tell you that. But also, if you have a combination of conditions, then your situation may be slightly different to if you have a condition on its own.
So we're going to be talking about percentages and changes to premiums, among other things. So we're just going to give some generic numbers. You can't take these numbers and apply them to your own circumstances, even though you're watching or listening to this particular part of the podcast. But can you give some ballpark figures for the cost of life insurance for different age ranges?
Absolutely. So when you're looking at life insurance, the younger you are, the less expensive it is. So if you're 25 years old and you want, say, £250,000 worth of life cover, maybe over the next 20 years, that's about £5 a month. You know, if you pushed it up to somebody that was 35 years old, that might go up to somewhere more like £8 or £9 a month. So the older you are, the more it costs, and it will cost more if you're also a smoker. So your premiums are calculated based on your age and your smoker status.
So if you're a smoker, is there like a finger in the air kind of percentage difference that somebody who is a smoker compared to a non-smoker, how much their premium would be higher?
It's roughly twice. So it's not an exact science, but roughly twice is what a smoker would pay compared with a non-smoker.
Okay, so for the rest of this piece of the podcast, if you keep those figures that Harvey's mentioned in mind, you can do the maths yourself in terms of identifying the impact of different medical conditions. But really the takeaway is, as you listen to what Harvey's got to explain on the various different conditions, is that it is still affordable. Some protection is better than none, so you can adjust your budgets. But really, I want people to realise that if you've got a pre-existing condition, I think some people think, well, it's not worth me applying just yet because I might not get accepted. We're going to dispel that myth. And also, if you've got a pre-existing condition, I'd actually personally argue it's even more reason why you probably need to be taking out life insurance now or seeking advice. So let's kick off with the first condition.
Okay, so the first one we chose was high blood pressure, largely because it's quite common. A lot of people do have high blood pressure, and actually quite a large number of people have undiagnosed high blood pressure and sometimes discover that whilst they're applying for life insurance. So it may be something that you're not aware of, but if you're on medication for high blood pressure and it's controlled, there's no reason why you can't get life insurance, and actually you may not even spend more on your life insurance than somebody who doesn't have high blood pressure. So generally, as a rule of thumb, life insurance companies like for conditions to be controlled, even if it's with medication or dietary changes, that your condition, if it's diagnosed, is within control. The range that we look at for high blood pressure is somewhere between 90/60 and 120/80, so sort of a normal range of blood pressure. And if you're within that range and it's been controlled over a period of time, there's no reason why you can't get life insurance. And even if it's not controlled, you should still apply for life insurance, because if the insurance company deems there to be a little bit of a risk there, they may charge you a little bit more. So instead of that £5 that we talked about earlier, you might end up spending £8 or £9 or maybe £10 a month for your life insurance. But the important thing is you can review that. So if you manage to control your blood pressure over a period of time, you can go back to the insurance company and say, my blood pressure is controlled now. Can you relook at this?
And would that be a whole new application with the same insurers? Your existing policy stays in place and they review your existing plan, or would you be going to somebody new?
So insurance companies change their guidelines from time to time. So it really depends on how long that period of time between you first applying and then coming back to your application is, because some insurance companies will require a new application if you go beyond a certain point. So it might be in 12 months' time that your old application isn't valid anymore, but within 6 months, perhaps you can revisit it. But that will be on an insurer-to-insurer basis.
So we're going to move on to the next condition. The next condition is
high cholesterol. So a little bit in line with high blood pressure, it follows the same pattern. So if your cholesterol has been raised in the past or you're on medication for high cholesterol, then as long as it is controlled with the medication, no reason why you can't get life insurance. And actually sometimes again, you may not even have to pay more to secure that life insurance. So it's really nothing to worry about. It's fairly common. Some people don't have it as a result of lifestyle. Some people have it because it's a hereditary condition that can pass down in the family. So insurance companies do look at that, and they do look at your health in the round before they make decisions. So they won't just treat you as a blanket. You've ticked the high cholesterol box, therefore we will treat you X. It really does depend on how you're managing your health and how you're managing that condition. But again, again, it's one really not to worry about. You're more than likely going to get life insurance. You may have to pay a little bit more in very, very small number of cases, but most people will be able to secure life insurance quite easily.
And so before we do the next condition, I think it's actually worth pointing out to people that when you take out a product, if you develop any of these conditions subsequently, it doesn't matter. It's not your premium is going to change, because if you've got a fixed contract, then the premium will stay the same as a guaranteed premium. You don't have to tell the insurer. So that is a completely separate thing. It's one of the reasons why you should get insurance when you're young if you need it, because your premium should be lower before you develop some other potential condition that would be treated as pre-existing. So next on the list is...
So we're going to talk about asthma. Asthma is fairly common. A lot of people suffer with it. Some people grow out of it, but some people will carry an inhaler. Maybe they haven't had an asthma attack in a very long period of time, but it's something you're asked about as part of your life insurance application, and therefore you should disclose it if it's something that you've been diagnosed with. Now, asthma doesn't present a problem for people applying for life insurance in most cases, but if you're a smoker and you have asthma, that may mean that the life insurance company will charge you a little bit more for your life insurance. Again, it shouldn't predicate you from having life insurance. It's merely a case of you're in a higher risk category if you're smoking and you've got asthma, as far as their guidelines will be concerned. Some insurance companies may be more lenient than others, and I think that's something that we should caveat for all conditions, that insurance companies don't have the same guidelines. They don't work with the same set of rules. So you may find that even if one insurance company has increased your premium, that another insurance company is happy to accept you without any increase to the premium. And that's quite normal to find as well. And you won't discover that unless you talk to an expert and really have the ability to shop the whole market. One of the other things that you should look at when you're looking at asthma is, if you're an asthma sufferer, have you been hospitalized in the last 2 years? If you have, that's something that can affect your application. It doesn't have to mean that your life insurance will be declined, but it's something that they ask about. If you need oral steroids, that's another thing that they will ask you about. Some people use a reliever inhaler, some people use a preventative inhaler, and you can discuss those things with the life insurance company. Generally, if your condition is controlled with the medication that you use, again, you don't really pose an extra risk and you should be accepted for life insurance.
And one thing I just want to point out, because there'll be people listening to the nuances of the decisions that can be made based upon your pre-existing condition and your medical history, never be tempted to not tell the truth on these things, because you will fall foul, or you'll potentially fall foul of non-disclosure. So if, let's say something was happened, you were to die, and the insurer might not pay out because you didn't disclose something on your medical history that they in the end found out about. And just to cover the point, how could they actually find out that you hadn't disclosed?
So not always, it's not a rule, but if insurance companies are suspicious about the cause of your death and that somehow you've died from a particular condition, and they're suspicious about how you disclosed your health at the time that you applied, and also even if it's a random check, insurance companies can write to your doctor for a full report of your health. Even if they didn't do that at the time that you applied, they may go back and check your health records when a death claim is made. Now, if something evidences that you had knowledge of symptoms or a condition that was diagnosed or ailments that you suffered that you didn't disclose and you were asked about as part of the application, then you can fall into the non-disclosure bracket. Now, I'm going to caveat that with only about 1% of life insurance claims ever get declined, but the vast majority of that 1% are because of non-disclosure. So don't fall into that trap.
And I don't want people to be frantic about, have I forgotten about anything in particular in my medical history? Because somebody like me who has quite a complicated medical history, the insurer will inevitably write to your GP, but there are instances where you can actually request that they do, because you don't know all the detail and you can't put it in the box. So it is better that way round, because you might end up finding that when they review the details, they won't necessarily, your condition isn't as bad as you think from an insurer's point of view. So that is an important point. So next condition, it's epilepsy, isn't it?
It is. So epilepsy is a common condition. People live with it. It can affect your life insurance application. But if you're applying for life insurance and you have epilepsy, they will ask you if you have the grand mal type, the petit mal type. If you haven't had a seizure for a long period of time, you've probably got nothing to worry about. You'll get life insurance if your symptoms are controlled. If you have had seizures and they're frequent and they're recent, then it might be a little bit more difficult to get life insurance. But again, you speak to an expert, they will put you in touch with an insurance company that is more lenient in their guidelines for epilepsy, because not all insurance companies will treat that the same. And it is important that you find the right insurance company for your particular symptoms of it, not just the condition itself.
Okay, moving on to the next condition.
Cancer, the big C one. So people that have had cancer often have a fear of death. And I think that actually it prompts people to think about life insurance, because I think a cancer diagnosis gives us that jolt that, perhaps life is finite and we should look at things like life insurance. But if you've been diagnosed with cancer in the past, you will still be able to apply for life insurance as long as there has been a certain period of time. So you're talking about a couple of years, what people usually call the remission period. So if you're in remission, you haven't had any treatment, your treatment's been complete for some time, and dependent on the type of cancer that you had and the staging that it was, you may be able to get life insurance still. And a lot of people just think after cancer, they won't be able to get life insurance. But it is good to ask the question, go down the route of an application. The experts that we'll link to in the programme notes, they'll tell you if your cancer means you can't get covered, they'll tell you straight off. They won't waste your time going through an application unless you can get cover. But for a lot of cancer survivors, life insurance is possible and you can arrange it.
So that will come as a surprise to quite a few people. As Harvey mentioned, we will be talking a little bit later about the people you can get in contact with to get advice, because one of the key things is when you go online and you may do a quote, the price that you see there will be often the assumption, because there won't be any medical questions associated with it, the cheapest insurer you might go for example. That won't necessarily be the best. What you've got to focus on is the ultimate premium that you will pay, but you won't know that until you've gone through that medical underwriting and they've seen evidence of your medical history. But the advisors, the people, the experts who deal with this all the time actually have insight into which insurers will be most lenient with certain conditions. So moving on, one of the conditions you're going to talk about is Crohn's, isn't it?
Yes, it is.
my personal favourite as a Crohn's sufferer.
I think, Damien, you can tell us all about Crohn's because you've applied for life insurance, you have life insurance in place, and you have had it in the past during periods when your Crohn was good and also during periods where your Crohn's wasn't so good.
Yeah, so for me, again, going back to a lot of the stuff you've been talking about already on this, I once applied at the point that I bought a house. I had an operation on my bowel, and looking back now, that's probably caused by stress. And I was refused, I was postponed is the actual term, life insurance. I applied because obviously I was taking out a new mortgage, and so they wouldn't cover me. They postponed me until after the operation that I'd had. And it was a period of about, I think it wasn't very long, it was up to about 6 months, and then I could apply again. But in the meantime, my wife was able to be covered because we got a separate policy. So it was fine. It's better to have some protection than none. And so after that postponement, then I was able to apply, and then I ended up getting a rating, and the percentage was about, for me, I think then was about 50%. And it all depends on your personal circumstances, but it does vary. It also does vary depending on the treatments that you have. There'll be people who have stomas, for example, and they may have had lots of operations or may have complications because of their Crohn's. So that can vary, but there are insurers that do look upon Crohn's, I wouldn't say favourably, but they're probably a little bit more kind in their assessment. So the premiums could be much higher than what I pay now for my life insurance. So what I would say, I'm evidence that you should definitely shop around. And subsequent to the scenario I just described, I did apply again to a different insurer, and then my premiums were slightly lower as part of me moving house. And so it's something that is worth reviewing because my health got better over time because of the treatment that I had.
And that's quite interesting because I think that some people, when they've bought their life insurance, if they had a condition and perhaps it was recently diagnosed, may be paying more than what they need to because they haven't revisited that life insurance. And it may be now because they've made some progress with that condition and it's controlled and they've perhaps recovered from the symptoms and they're not having as many flare-ups, that they should revisit that life insurance.
And on a point you mentioned earlier, I don't want to just focus on Crohn's because I suffer from it. But when I was the first of a number of operations I had way more than a decade ago, and some of the drugs didn't exist. So there are certain drugs now that I take as an infusion every 2 months. So I sit in the hospital, have a drip, talk to the nurses, get a cup of tea, and that keeps it in almost remission. It keeps it under control. So I haven't had a flare up of any kind now for probably about a decade. So that is different to when I applied, say, 15 years ago. That wasn't an option. Surgery was pretty much the only option I had at that point. So the landscape also changes. So inevitably, underwriters' view of certain conditions will change over time, because mine is now, thankfully, I'll say touch wood, under control, but it wasn't back then.
No, absolutely. And I think many conditions do get better with treatment, and there are advances in medical science and research that help people to live longer with certain conditions than they perhaps did in the past. So the other one that we're going to talk about today, Damien, is diabetes. Again, really common. You can have type 1, you can have type 2. Type 1 is the one where you take insulin, and type 2 is the one where generally you'll be taking some kind of medication, or it may be diet and lifestyle controlled. Now, diabetics generally will see some sort of increase to their life insurance costs because of the risks that are associated with diabetes. And for those people that have diabetes, if it's uncontrolled, you're likely to pay more. So you're probably still going to get life insurance. That's the upside, but it's how much you're going to pay for that life insurance. So if you're a diabetic and you're a good diabetic, now diabetics that are listening to this will understand HbA1c, which is your sort of control reading if you're a diabetic. If your HbA1c reading is good and shows good control, then you're likely to pay less. And if that's over a long period of time, even better, you'll pay even less. If it's not so controlled, again, we've got to go back to the same thing as the Crohn's. You pay what you need to now, but you review it in a period of time. So if you feel that it's more controlled now, you're on top of your diabetes and your checks are regular, then you'll pay less. So review your life insurance. So again, if you're somebody who started your life insurance at a time when it cost quite a lot because of your diabetes, but now your diabetes is well managed, again, revisit your life insurance.
Okay, so we're going to rattle through the last of the conditions.
Yes, we are. So it's quite common for people to disclose a period of depression, stress, anxiety, other mental health disorders. Life insurance applications do ask you about your mental health. So be prepared if you have had an episode of this. This is something that you may have to disclose. It's completely understandable if people don't want to talk about it, but say yes, because that will avoid the situation where a life insurance claim might be declined once you put your life insurance in place. You can refer it to your doctor. So you can ask the insurance company to ask your doctor about things. But largely, you'll be able to give a lot more information about your period of mental health than perhaps your doctor will. So very often life insurance companies want to look at things in the round. So if there's been a trigger for a mental health episode that you've had, and that could be work stress, it might be a bereavement, it might be anything else, life challenges us and some of us respond in different ways. Life insurance companies are quite lenient with that because it's a natural part of life to react in that way. But actually, if it's something that's chemical, it might be treated slightly differently. Again, you should speak to the experts because life insurance is available to people that have had depression, stress, anxiety, bipolar disorder, these types of conditions in the past, or perhaps still are living with them. But if they're controlled and you're on medication, don't let that be a reason why you don't apply for life insurance. It's available for you. So the other thing that comes up on life insurance applications quite commonly is your height and your weight. So you are asked, and people find this quite an intrusive question sometimes when you're going through an application with somebody, but your height and your weight will be asked, and that gives them something called your body mass index. And your BMI, if people have come across that before, is an indicator of the distribution of weight across your height. You can use the NHS calculator and work out your BMI. We'll put it in the notes. But if your BMI is less than 30, generally no problems getting life insurance. You'll be absolutely fine. If it's slightly more than 30, again, you probably still will get life insurance and you probably won't have to pay any more than anyone else for your life insurance. Now, if you get over sort of 35 and coming towards 40, you may have to look at insurance companies that are a bit more lenient their underwriting guidelines for that. They will ask you things like your waist size if you're a man and your dress size if you're a woman. That kind of gives them your body shape. People that carry more weight in their middle generally treated a little bit more poorly than people who have a distribution of weight. So that's another indicator, and you can offer that information to the insurance company. If you feel that you're a muscly person, perhaps you're into your bodybuilding and that's why you carry a bit more weight, the insurance company usually take that on board, but you shouldn't really pay more if you're within those parameters. And if you do pay more, you'll find that by shopping around and finding the right insurance company, you pay less. And the last thing we want to talk about is family history of conditions. So some people are surprised when a life insurance application will ask them about their family history of health. So if your mother, father, brother or sister, and those are the only people you have to worry about, you don't have to worry about your cousins and your aunties and uncles and grandparents, your life insurance application will only ask you about your immediate family. They will ask if they have had certain kinds of conditions. Cancer is a big one, but it's only if they were diagnosed before sort of 65 or 60. If you don't know this information, better to say you don't know, so if you're unsure about giving that information, say you don't know. But if you do say yes, generally having one family member that's had a condition that you've had to say yes to won't stop you from getting life insurance. You probably won't have to pay any more than the next person. If you've got multiple members of family who have a particular condition and there's a strong hereditary link to that condition, then the insurance company may charge you a little bit more for your life insurance because they may see that as a risk. Again, shop around. I sound like I'm saying the same thing again, but it is so important because insurance companies do not work to the same guidelines. And just because one insurance company has either declined you or charged you a large amount extra on top of your premium doesn't mean that the next insurance company won't. And one of the interesting things that you and I were talking about before we came in to record this was that actually often if you go to a comparison site and you find the cheapest insurance company, they're probably the strictest in their guidelines because they like to keep their risks low in order to give those very cheap quotes. And you may have to just go to an insurance company that may only be 50 pence a pound more, and suddenly their underwriting guidelines are so much better for you.
So everybody listening to this podcast, I'm sure there's lots of people who will be wanting to access Harvey's encyclopedic knowledge about everything to do with protection, whether it's life insurance, income protection or critical illness. What I will say is that Harvey has probably written about most conditions associated with an application for things like life insurance. So do search on the Money to the Masses website because you'll find out lots of information on there about lots of different conditions that we haven't had time to talk about. And I know Harvey was saying she was conscious about saying shopping around, but there's an important point. For me, for example, I used a company of experts in their field who could access all different insurers, know their underwriting guidelines to give me the best policy for me. So that company, we will put a link in the show notes to a company that I've personally used and pretty much everybody at Money to the Masses has used for their protection. So life insurance, income protection, critical illness cover. And the company gives free advice on the various different options open for you. So I would suggest that you have a conversation with them. You will potentially get up to £100 cash back, and that's on a joint policy. So there is a benefit of going through that particular link. You don't have to, you can go directly, but you won't get the cashback offer. And in addition, it does help Money to the Masses as well, because we do get a referral fee, but that doesn't cost you anything or impact your prices. Now, the one thing I would point out, picking up something else Harvey said, they won't waste your time. There is no obligation when you have a conversation with them, but if you can't get insurance, they will tell you, and they'll be very upfront about what you can be expected to pay. So if anything, it will actually save you time. And if you've even got existing policies you may think need to be reviewed, it's not just for people who are out there thinking, I've been putting this off, it's now time for me to actually have a conversation. It's for people who've got existing policies like I did. So make sure you do. I think that was a fantastic piece, Harvey. I know there'll be people out there who will, take in your BMI example, may be thinking, do you know what, I'll wait to apply when I've lost the weight because I'm more likely to be accepted or more likely to get a cheaper premium. But the reality is life is busy, things change. So I would urge people to seek advice because you may be pleasantly surprised about what you can get. So Harvey, thank you for coming onto the show.
Thank you for having me.
So moving on to the final piece of the podcast, Andy, we're going to be talking about children working, how much they can earn.
That's right. So we were talking about it in the office. We've got children who are now teenagers and they're asking the question, can I work? Can I get a job? They're interested in earning a bit of money for themselves and, getting a bit independent. They've got their own bank accounts now. We've gone through Go Henry and the various apps where they can actually start managing their money. They now want to start earning it, which is great for us as parents. So just to go through what the rules are. So the general rule is that a young person of school age, so that's 16 or under, can get a part-time part-time job from the age of 14. They can technically actually get a job from under 14, so the age of 13. However, it often depends on certain bylaws and certain local councils. So if it's a friend of yours that's offering a job, that's generally fine. But when we're talking about actual jobs with various people, whether it's like a business, they'll need to check with the local council because there's certain laws that you need to just be careful of. And so when we're talking about young people starting off in the world of work, there are some rules that they need to be aware of and you as parents need to be aware of. The first thing is what is considered work. They can generally only take on what is considered light work while they're still at school. And this means that they can't do a job that is going to affect their health and safety or interfere with their education, which obviously makes sense. And typical examples of jobs like that are delivering newspapers and leaflets, working in a shop, stacking shelves, working in an office environment, working in salons, working in a cafe and restaurant, or hotels and other places like that. So what we're interested in as parents, and our children are obviously interested in knowing, is how much they can earn in terms of pounds and pence, but also how many hours they can do, because there are stipulations. So let's go through the numbers. So during school term time, there are limits. 13 and 14-year-olds can only work for a maximum of 12 hours per week. And that is broken down to a maximum of 2 hours per day on a school day or Sunday and 5 hours maximum on a Saturday. So if you think about the kind of work they're doing, we talked earlier about leaflets and things like that. They could do that after school. And if they're doing a Saturday job, they could work in a shop or a salon for up to 5 hours during term time. That enables them to basically concentrate on their studies. If they're 15 or 16, those hours are slightly different. I mean, it's still 12 hours maximum per week. 2 hours on a Sunday or weekday, but they upped it to 8 hours on a Saturday. So they can do a full working day on a Saturday. And so during school holidays, there's good news. 13 and 14-year-olds can actually do double the amount of hours, so up to 25 hours per week in terms of work. And that's 5 hours on a weekday and also on a Saturday. And actually the Sunday hours are reduced to only 2 hours. And if you've got a 15 or 16-year-old, they can work quite a lot of hours, really, looking at it, up to 35 hours per week. And that's 8 hours per day, Monday through to Saturday, with only 2 hours maximum work on a Sunday.
So one of the questions we had in our house, we had a discussion. So my daughter falls within one of those age brackets, and there was a discussion about they've been offered this kind of possible part-time job to help out with a after-school club from it wasn't actually the school itself, it's an external company, and they could earn some money. Of course, then we were talking about, well, how much can they earn? Because you don't want them to be exploited. And this is where it also gets interesting about, well, how much could or should the child earn if they do a job when they're a teenager?
Yeah, this is where it gets a little bit tough, because there is no official minimum wage a young person can earn if they're still at school and under 16. There's this thing that is talked about called a fair wage, which when you sort of look around the internet, what people are saying is these are young people, they're willing to work. You don't want to discourage them by paying a miserly amount. So the advice that I've seen, and these are from websites such as read.co.uk, a recruitment website, is that potential employers should be paying the effective equivalent of what is the national minimum wage for a 15 or 16-year-old, which is currently £5.28 per hour. So that's a sort of guidance. Around £5 an hour is a good wage for an under 16 to earn. But of course, there's no legal requirement for the company to do so.
So that's interesting. Now, taking that on, it seems a good opportunity to remind everybody what the current national minimum wage is.
Yeah, so I can go through the numbers. Now, by the time most of our listeners listen to this particular podcast, there's likely going to be an update to this, because the Chancellor, Jeremy Hunt, is expected to announce a rise to these numbers. So this is currently, as we were recording, the expected announcement is that the top rate will go up to more than £11 an hour. And that's a key number because obviously it's never been more than £11 per hour. Let's go through the numbers. So on the younger end of the scale, because these numbers are different depending on the age and experience. So apprentices that are age 16 to 18 on their first year of apprenticeship, they are able to earn a national minimum wage of £5.28 per hour. And for those aged 18 to 20, the national minimum wage is £7.49 per hour. If you're aged 21 to 22, the national minimum wage is £10.18 currently. Again, this is at the time of recording. And those aged 23 or over, they actually get something called the national living wage. So the name of that slightly changes. It changes from a minimum wage if you're 22 or under to a national living wage once you turn age 23. And that's £10.42 per hour at the time of recording this podcast. As I say, there is news that could be north of £11 this week.
So that's a really interesting piece, Andy, and I do apologise to all the children of podcast listeners who are now going to be getting some lecture on Sunday to say that you can go to work and you can earn X, Y, and Z. So we apologise for that we've probably driven some parents to encourage their children to go to work. But Andy, that was brilliant. So that is it for this week on the podcast. I mean, as ever, do make sure you join the Facebook group, facebook.com/groups/money to the masses. One thing I do want to point out that if you've heard some strange heavy breathing during this episode, we did have Lola in the studio. So Lola crept in while we were recording. It's the second time she's done that in the last couple of months. We left her. She went under the sofa, and then she popped back out after about half an hour sleeping under there while we did the podcast and wandered round. She was evicted, actually, during the second and third piece of the podcast, if you're interested, because she had to go back with the others because she was starting to become a little bit naughty.
And just to fill those listeners in that don't know who Lola is, she is the office pet. She's my pet. She's a miniature schnauzer. She's 3.5 years old. She's officially a lockdown puppy, and she's part of the Money to the Masses fabric now.
Yeah, she is. And you'll see pictures of her on our socials, which is, again, to finish my bit of admin, make sure you do follow us on Instagram as well, not just to see pictures of Lola, but also the other stuff that we do, because there is content on there that we don't necessarily have on other areas of Money to Masses. And also do make sure you follow us on YouTube, because we're regularly doing exclusive content on YouTube. For example, I'm just about to record after this show pieces about the latest cash incentives for switching your current account, and they're being updated all the time because of, well, interest without the pun in savings accounts, and banks are trying to attract new customers. So do make sure you follow us on all of our social channels.
And can I just reiterate that please do get in touch. Don't think to yourself, oh, they'll never listen to me, or they won't read it out, or they won't take any notice. We read everything that's sent in, and it really inspires. If it's positive, great. Even if it's just a suggestion or just to say hi, please do email us, because we read everything. The amount of times we get an email and it becomes an inspirational piece that we end up doing on a podcast in future weeks. So it's Andy@moneytothemasses.com or Damien@moneytothemasses.com. We'd love to hear from you.
Yeah, and you can also send us messages via our socials, say, for example, Instagram. Because don't forget, 2 people or 3 people before I even came onto this show were emailing me about money dashboarding. It's going to be a piece on next week's show.
Yeah, absolutely. So that's it for this week's pod. Until next time.
Until next time.